After a dismal October, Wall Street is opening in November on an optimistic note. Jerome Powell unexpectedly acted as an ambassador for a rally in the stock market. The Fed's chairman was traditionally cautious but dovish at the same time. Eventually, investors found the light at the end of the tunnel, or the signs that the Fed is completing its monetary tightening. Thus, there are new fundamentals for growth in stocks. Investors are regaining the appetite for risk. For a start, let's sum the upbeat results of the first day of the month. The three benchmark stock indexes perked up amid the prospects of the completion of the cycle of rate hikes. The Nasdaq looked the strongest intraday gain of 1.64%. The S&P500 implemented the most optimistic forecast by our analysts and climbed by 44 points, or 0.05%, to close at 4,237 points. The index is extending its growth for 4 days in a row. Futures on the stock indexes rose by 0.6 and 1.3% before the opening bell. Bullish targets for the S&P 500 will be the area of 4,300 and 4,310 points. The thing is that a lot of economic data is due tomorrow, so the S&P 500 might trade today in a modest corridor between 4,260 and 4,290 points. The Federal Reserve stood pat on interest rates on Wednesday as expected, though Fed's chairman Jerome Powell left the door open for another rate hike. He also acknowledged the influence of a recent rally in the Treasury yields on the economy. Powell said that policymakers would act cautiously, though they are not sure yet that financial conditions are restrictive enough to bring inflation down to the official target rate. The fact is that Jerome Powell was not adamant about raising interest rates for longer as he did at previous press conference. It means that interest rates could be kept at elevated levels for longer. Earlier, Wall Street received a boost from a decline in Treasury yields after the Treasury Department said it intends to continue gradually increasing coupon auction sizes from November to January. Among 11 sectors of the S&P 500, only 2 lost ground. The energy sector slipped by 0.3% and the consumer goods sector inched down by 0.06%. The information technology and telecom stocks logged the strongest performance. As for separate stocks, shares of advanced micro devices jumped by almost 10%. Following an optimistic forecast of sales of chips for artificial intelligence. Today, the stock market is likely to focus on corporate reports. The economic calendar for the United States is almost empty, and those data which have already been released could fit the risk-on mood. The number of initial unemployment claims in the United States increased by 5,000 for the first time to 217,000 last week, beyond the consensus of 210,000. The reading is the highest in the nearly 2 months. A separate report showed that unit labor costs, excluding farm employment, dropped by 0.8% in the third quarter from 3.2%. Analysts had projected growth of 0.7%. The data is a flash estimate, but it's the first sign of a decrease in unit labor costs since the fourth quarter of 2022. No doubt, the U.S. non-farm payrolls for October will take center stage this week. Still, the fresh statistics could be a decent argument for optimism. Another reason is a decline in the yields of 10-year treasuries to 4.65%, the lowest level in more than 2 weeks. Another report worthy of note today is the factory orders for September. More top US companies are due to report on their corporate earnings. Meanwhile, Qualcomm shares surged by 5.7% after the chip developer predicted sales and profits in the first quarter above Wall Street estimates. PayPal shares leapt by 6.1% as the payment giant upgraded its forecast of profits for the year ahead. Apple shares grew by nearly 1% in anticipation of the quarterly results of the high-tech giant. The report will be available after the opening bell today. In the meantime, the currency market mirrors the mood opposite to the stock market. The US dollar plunged today. Its index stumbled by 0.92% to trade at 105.90 at the time of recording this video. The pessimistic forecast for the instrument is a drop to 105.70 and 105.50. The more realistic scenario is a recovery to 106.10 and 106.20. The greenback is weighed down by the likelihood of the completion of the monetary tightening and Powell's speech. Now, according to the Fed Watch tool, traders downgraded the chance of a rate hike in December to 20% and in January to 25%. Besides, the market allows for a 70% chance that the Federal Reserve is winding down its cycle of monetary tightening. Under such fundamentals, the US dollar needs widely arguments for growth. The non-farm payrolls tomorrow might not support the US dollar strength. Like most major currencies, the Canadian dollar is a beneficiary of the greenback's retracement. The USD CAD pair fell to 1.3780 before the opening bell, trading 0.54% down, and the intraday corridor for the instrument is seen between 1.3740 and 1.3820. Tiff McClam's press conference yesterday did not bring crucial news, and the Bank of Canada's governor said that if the current plans for budget spending are maintained, they would hinder the bank from pushing inflation down to 2%. McClam added that cuts in the budget spending would help the central bank to tame inflation faster, but the bank allowed for the oil risks. The commodity-dependent loonie benefited from a rise in oil prices as well as the soft US dollar. The crypto market has not found the firm soil for a confident rally yet. Bitcoin retreated to $35,000 in the New York pre-market, trading 1.1% down. As for the intraday outlook, the buyers are making efforts to keep the price above $35,000 and $35,200. If the bulls manage to hold the price within this range, Bitcoin might try again to climb above $35,500. The alternative scenario is a fall to $34,700 and $34,300. Today, as part of PayPal Holdings' earnings report, it became known that the Securities and Exchange Commission issued a subpoena to the company for issuing a stablecoin. Despite the fact that the payment giant announced cooperation with the Commission and its readiness to defend its rights, the news slightly spoiled market sentiment. We hope that our market reviews helped you make well-rounded trading decisions. Your feedback and questions are appreciated. Good luck in your trading and see you online tomorrow.